Welcome to the deep dive. You know those dense auditors reports, the ones usually tucked away deep inside a company's financials? Yeah, most people just kind of glance over them, right? If they even look at all. But what if I told you they're actually like packed with some of the most critical insights into a company's real health? Today, we are pulling back the curtain on audit opinions. We're going to crack open what they are, why they're so incredibly important, and what each type really tells you about a company's financial story. Our mission: cut through the jargon, give you a clear understanding that'll honestly change how you look at financial statements. Get ready for some real aha moments here. So let's jump right in. What exactly is an audit opinion? Why do companies even need one?
Well, at its core, think of an auditor's job like being a financial detective, maybe. Their main goal is to form an opinion on whether the company's financial statements are presented fairly. Yeah, fairly in all material respects. And that's according to a specific rule book, what we call the applicable financial reporting framework. Like GAAP, generally accepted accounting principles here in the US.
Okay, GAAP. So that's the standard.
Exactly. It's really all about transparency and building trust for investors, lenders, anyone looking at those numbers.
So our financial detective, what are they actually looking for when they're forming this big opinion? What are the key pieces?
They're mainly focused on, let's say, three big pillars. First, did they gather enough sufficient appropriate audit evidence? Basically, good proof.
Good proof. Right.
And that's required by their own professional standards, GAS, generally accepted auditing standards. Second, they're hunting for material misstatements.
Material misstatements, so significant errors.
Pretty much any error or omission, big or small, that's significant enough that it might actually matter to someone making a decision based on those financials. Could it change your mind?
Makes sense.
And third, they're checking if the statements are prepared correctly, following the rules of that framework we mentioned, like GAAP. Are they playing by the accounting rules?
Wow. Okay. So it's not just the bottom line number, but how they got there. What actually makes up a complete set of financial statements they're looking at? Is it just like profit and loss?
Oh, definitely more than that. A complete set usually includes the balance sheet, that's your snapshot of assets and liabilities, then the income statement showing revenues and expenses,
Okay.
also a statement of changes in equity, a cash flow statement tracking the actual cash movement, and crucially, all the notes and disclosures.
The notes, always important.
Incredibly important. They fill in the details, provide context. The specific framework, like GAAP, dictates the exact format, but those are the usual suspects.
So beyond the actual numbers, what else is the auditor evaluating? It sounds like more than just number crunching.
Precisely. They take a step back, look at the overall quality, the presentation. Like, did the company adequately disclose its accounting policies? Are those policies consistent, appropriate? They also look at management's estimates, things like how long will this machine last? Are those estimates reasonable? And really the overall quality of the information. Is it relevant, reliable, comparable year to year, understandable?
So user-friendly in a way.
Exactly. Are there enough disclosures for you, the user, to really get what's going on with important transactions? Is the terminology right? Is the overall presentation fair? Do the statements truly reflect the underlying business? And maybe a quick clarification here. JAS, the auditing standards, tell the auditor how to do the audit, like go observe the inventory count. The financial reporting framework, like GAAP, tells the company how to record and report things, like you don't depreciate land. See the difference. Method versus rulebook.
Got it. One's the how-to for the auditor, the other's the what to report for the company. Okay, so most companies, they want that unmodified or unqualified opinion, right?
Right.
What does that actually signal to us, the users?
That's the gold standard. The clean bill of health, basically. An unmodified opinion means the auditor believes the financial statements present fairly in all material respects the company's situation, its finances, operations, cash flows, and that they follow the rules, the framework.
So trustworthy numbers.
Very trustworthy. It's like saying, yep, these books look good, you can rely on them. For an investor, that's huge. Oh, and quick terminology note. Usually unmodified for private companies, unqualified for public ones, but they mean the same thing. A clean opinion.
Okay, unmodified, unqualified. Clean. So if I pick up a report with this clean opinion, what are the key sections I should look for?
Sure. For a non-public company, look for the title. Independent Auditor's Report. Clear signal. Then the addressee, who it's for, maybe the board or shareholders. Then the crucial opinion section. This flat out states what was audited and gives the auditor's conclusion the clean opinion itself. After that, you've got the basis for opinion section.
Basis for opinion, what's in there?
That explains how the audit was done. Confirms they followed GAS, states they're independent, and that they believe they got enough evidence.
Okay.
Then there are sections on management's responsibilities, clarifying management owns the financials and internal controls, and auditors' responsibilities.
And what does the auditor's responsibility section tell us?
It details their objective to get reasonable assurance, not absolute 100% certainty, but a high level of confidence that the statements are free from material misstatement. It mentions their professional judgment, skepticism, how they assess risk.
That's important.
Yeah.
Reasonable assurance, not a guarantee.
Yeah.
What does that mean practically? Should we worry it's not 100%?
That's a really good point. Reasonable assurance means, well, they're highly confident based on the evidence, but auditors can't check every single transaction, right?
Right, that would be impossible.
Exactly. They use sampling, they make judgments, and there's always a small risk that, very clever fraud might slip through or management might override controls. So it's not 100%, but it's a very strong level of assurance based on rigorous work. You can rely on it, but just know it's not an ironclad guarantee against any possible error.
Okay, that makes sense. Now, sometimes, even with a clean opinion, there's extra stuff, right? You mentioned explanatory paragraphs for public companies, or emphasis of matter, or other matter paragraphs for private ones.
Yes, exactly. Think of these as like a helpful signpost. They say, hey, pay extra attention to this specific thing. It's used when something is already properly disclosed in the financials, but it's so important, so fundamental that the auditor wants to highlight it.
But it doesn't change the clean opinion.
Correct. Crucially, these do not modify the opinion. The opinion stays clean. Examples might be a big justified change in an accounting principle, or maybe an unusually significant lawsuit that's been properly disclosed. It just draws your eye to something critical that's already there.
Okay. What about those key audit matters, CAMs, or critical audit matters, CAMs? What are they about?
CAMs and CAMs. These highlight the areas of the audit that were the most significant. Often they involve really challenging or complex judgments by the auditor.
So the tricky parts of the audit.
Pretty much. The report describes these matters in a separate section. It gives you more insight into the audit process itself. For CAMs and public companies, they explain why it was critical, how the auditor addressed it, and where you can find the related info in the financials. It's about transparency into the auditor's toughest calls.
Interesting. A peek behind the curtain. And finally, on the report itself, the date. What's the significance of the date of the auditor's report, and what's dual dating?
Good question. The date on the report is basically the cutoff point for the auditor's responsibility for gathering evidence. It shows the last day of their fieldwork. Dual dating is a bit different. That's when something important happens after that main report date, but before the financials are issued. The auditor might keep the original date, but add a second, later date just for that one specific event. It extends their responsibility, but only for that single item they addressed later.
Okay, I see. So we've covered the ideal scenario, the clean opinion. But what happens when the auditor finds problems? When do opinions get modified, and what's that telling us?
Right, modifications. This happens when the auditor can't issue that clean opinion, and it's generally for two main reasons. Either the financial statements themselves are materially misstated, there are significant errors, or they break the accounting rules.
Okay, problem with the numbers.
Or the second reason, the auditor couldn't get enough appropriate evidence, they weren't able to do all the checks they needed. We call that a scope limitation.
Scope limitation, got it. And this leads to the idea of pervasiveness, right? What does that mean? How widespread does an issue have to be?
Pervasiveness is key here. It's about how broadly the problem spreads. Is it confined to just one specific account, or does it affect many accounts? Or, even if it's just one area, does it represent a really substantial chunk of the financials?
Okay.
Or maybe it relates to the disclosures. Are the disclosures so fundamentally lacking or misleading that you basically can't understand the company's situation without them? If the impact is that widespread or fundamental, we call it pervasive.
So it's about the depth and breadth of the problem. Okay, what if there's a misstatement that's material, it matters, but it's not pervasive? Like it's a specific issue, but not wrecking the whole picture.
That leads to a qualified opinion due to the financial statement issue. The auditor is essentially saying, okay, except for the effects of this one specific thing we found, the financial statements are presented fairly.
Like a footnote on the opinion.
Kind of. It points out a specific flaw. Examples could be using the wrong accounting policy for something specific, maybe expensing a big asset that should have been capitalized, or even leaving out a required statement, like the cash flow statement. The report will clearly state qualified opinion and have a section explaining exactly what the issue is.
But what if the misstatement is both material and pervasive?
Huh.
That sounds much worse, like the foundation is cracked everywhere.
It is much worse. That's when you get an adverse opinion. This is the most negative opinion possible. It's a direct statement. The financial statements do not present fairly, full stop.
Wow. So basically, don't trust these numbers.
Essentially, yes. The auditor is saying they are fundamentally flawed, misleading. Think of a company not consolidating a subsidiary it controls, or valuing assets based on some arbitrary appraisal instead of cost, if that has a huge widespread effect. That could trigger an adverse opinion. And notably, if an adverse opinion is issued, you usually won't see CAMs or CAMs described because the whole set of financials is deemed unreliable.
Okay, that covers issues in the financials. But what about the other reason for modification the auditor couldn't get enough information? The scope limitation.
Right, the scope limitation. If the auditor can't get enough evidence, there are two possible modified opinions. First, it could be another qualified opinion, but this time due to the audit issue.
So, qualified again, but for a different reason.
Exactly. This happens if the possible effects of undetected misstatements, because they couldn't get the evidence, could be material but not pervasive. The wording changes subtly to except for the possible effects of the matter.
Possible effects
Yeah.
because they don't know for sure.
Precisely. They couldn't verify something. Maybe they couldn't observe inventory counts because they were hired too late, or they couldn't get confirmations back on receivables, or maybe management refused to give them a required letter. But importantly, if the auditor can find the evidence through other means, alternative procedures, then it's not a scope limitation.
Okay. What's the second option if they can't get evidence?
The most severe outcome from a scope limitation is a disclaimer of opinion. This is where the possible effects of undetected misstatements are considered both material and pervasive. The auditor basically throws up their hands and says, we cannot form an opinion.
So a disclaimer means the auditor is effectively saying, we just don't know. We couldn't find out if these are fair or not. That's a huge red flag.
It's a massive red flag. The report will explicitly state, we do not express an opinion and explain why. Often the wording changes from we have audited to something like we were engaged to audit, reflecting they couldn't complete the job. A disclaimer is also issued if the auditor isn't independent or if the statements are simply unaudited. And consider this, if financial statements are unaudited and contain an obvious error the client refuses to fix, the auditor, if associated, should add a paragraph to their disclaimer describing the error. If the client still refuses to accept that modified disclaimer, the auditor should seriously consider withdrawing from the engagement entirely.
Wow, withdrawing. That really shows how serious they take not being associated with misleading information. Okay, we've hit the main opinion types. But audits get complicated, right? What about comparing different years or when different auditors are involved?
Yeah, those nuances are important. When you see comparative financial statements, the auditor's report usually covers all the years presented, and the opinions can actually be different for different years. You might see a qualified opinion this year, but last year was unmodified.
So you have to read carefully for each period.
Definitely. And sometimes an auditor needs to update a prior opinion. Maybe new information came up, forcing a restatement of last year's numbers. If the opinion changes, the report has to explain why, reference the old report date, the old opinion, the reasons, the changes, and state the new opinion. Then you have predecessor auditors. When a company changes auditors, what happens? If the old auditor's report is reissued with the new one, they have certain procedures. If it's not reissued, the new auditor, the successor, mentions the prior audit in an other matter or explanatory paragraph. They say who did it, the opinion, the date, but usually don't name the old firm unless there was a merger.
Okay.
And if the prior year wasn't even audited, maybe just reviewed or compiled, the current auditor adds a paragraph clarifying the status of those prior periods so you know the level of scrutiny they received.
That makes sense. Now, what really fascinates me is that large companies, subsidiaries all over the place, how do they handle audits when maybe different audit firms work on different parts?
Great question. That's reporting on audits of group financial statements. You have the main auditor, the group engagement partner responsible for the whole thing, and then potentially component auditors doing work on, say, a subsidiary.
Yeah, group and component.
The group partner has two main options for dealing with the component auditor's work. Option 1, make no reference. The group auditor basically takes full responsibility for the component auditor's work as if they did it themselves.
So they absorb the responsibility.
Right. Option 2, make reference to the component auditor. This is only allowed if the component auditor did a proper audit under the right standards and their report isn't restricted. If they make reference, the group report has to be clear that the group auditor didn't audit that part, and crucially, state the magnitude, like the component auditor audited entities making up 20% of assets and 18% of revenues.
Ah, so you know how significant that other auditor's work was.
Exactly. And if that component auditor issued a modified opinion, the group auditor has to figure out how that impacts the group financials overall and might need to modify their own opinion.
Complex stuff. Okay, one last big area. Subsequent events. Things happening after year-end but before the statements are officially out. What's the auditor's role then?
They have to stay vigilant right up to their report date and sometimes even consider things after. There are two types of subsequent events. First, recognize subsequent events. These provide evidence about conditions that already existed at the balance sheet date.
Like what?
Like a lawsuit was pending at year-end and it settles after year-end but before issuance. The settlement provides a known value for that existing condition. Or a major customer with a big receivable at year-end goes bankrupt shortly after. These events require adjustment to the financial statement numbers.
Okay, adjust the books for those.
Then there are non-recognized subsequent events. These relate to conditions that did not exist at the balance sheet date but arose afterward. Think a major fire destroying inventory after year-end, or the company issuing a lot of new stock or bonds after year-end.
So new events.
Right. These generally do not require adjustment to the numbers, but they might need to be disclosed in the notes if omitting them would be misleading. Auditors have specific procedures during this subsequent period, reviewing transactions, getting management letters, talking to lawyers, reading minutes, checking interim financials.
Okay, so they're actively looking. But what if something really big, really material, comes to light after the audit report has already been issued and sent out? What then?
Yeah, that's the tricky one. Generally, the auditor has no active duty to hunt for things after the report date. But if they do become aware of something crucial, something that existed at the report date, which, if known then, would have changed their report, they must act.
What do they do?
First, they determine if the information is reliable and if people are likely still relying on the original report. If yes, they advise the client to disclose the information immediately, maybe issue revised financials, maybe just make new disclosures.
And if the client refuses?
That's serious. If the client refuses to act, the auditor has to notify the board of directors. They need to inform regulatory agencies, if applicable, and they have to notify anyone they know is still relying on those original financial statements that the audit report should no longer be relied upon. It's a major step, usually involving legal advice, to prevent further reliance on potentially misleading information.
Wow, okay, so pulling this all together, what does this mean for you, our listener, next time you're looking at a company's financials and see that auditor's report?
Well, understanding these opinions, it isn't just for accountants. It really empowers you to look critically at the information companies put out there. A seemingly small phrase or an extra paragraph in that report can signal some pretty significant underlying issues. Or conversely, it can really underscore solid financial health.
Exactly. Helps you get past the headlines, past the summary numbers, and really understand the story the financials are telling. So the next time you see an auditor's report, hopefully you'll know exactly what to look for, what those different opinions mean, and why it matters. Thank you so much for diving deep with us today. Keep digging for those insights. We'll see you on the next deep dive. And maybe a final thought to leave you with. Just consider how much responsibility really rests on that auditor's shoulders. It's not just about finding errors, is it? It's about interpreting the significance, the pervasiveness of those errors, and using professional judgment that ultimately shapes how much trust we can place in financial information. It's definitely more than just checking boxes.